Hey everyone, welcome back to the YouTube channel. I am Xavier Smith, and today in this video, I'm going to go over this strategy that my dad and I have been using with options. And as you can see, my goal is 1% a week. And doing this was like the second week I've been doing this strategy. I was up 3.5%, which is much more than I needed. And past month is 9%. So I'm clearly doing well. I think this is when I started the strategy here, like January 30th, and I pop the first day, and then I kind of just keep riding up. And then I did something wrong over here with one of the stocks because I betrayed one of the rules. So I'll basically give you what the strategy is, really how to implement it, and then like the rules, like what you should do. And I think you're going to make a ton of money. So let's get into it. First, this is an option strategy selling puts on earnings. A lot of people they say do not do like options on earnings if you're selling them because they could go super wrong because there's so much volatility on earnings. Things could shoot up or down 15%, or they could shoot up 15%, come right back down to their normal price, or whatever. So the options, since things move so much on earnings, like due to good news, like if they beat earnings, there's a lot of the time the stocks will shoot up 15%. So the options, like the calls, will be worth a lot, right? Because people are speculating the stock's going to jump. And it's the same thing with the puts. People think it might drop a ton, so they're buying the puts. So the prices are really elevated for these options. But what that means is that options that are really, like strike prices are really far away, like 20% down, can still pay you a nice premium. So I'm going to show you how to find some of these stocks that have earnings. You can look in a lot of places to find earnings, but I like Earnings Hub. It's just got a nice little layout. Check out this week's earnings. And this week, the thing is, you could roll 1% a day and just do that like every day for 5 days in the week. Okay. So first, I've already looked at some of these stocks. I'm going to be showing you Wix, which is a decent one. It's not the best. Carvana, and then I'm also going to show you Hims, just because. So there's all these stocks. You probably know a lot of these names, and you can go searching around and seeing what really beats the rules. So first, I'm going to show you like a good example, which is Carvana. Okay, so if we go to CVNA, Carvana, we're just going to look at what price it's at in relation to a lot of times. Well, we can see it clearly went up in the 300s, and then it kind of dropped off, and it's coming back, right? Like just from January 3rd, it's from 177 to 284, so we have to be pretty aware of that, right? It took a month and a half to get up that much, but we have to be aware, okay? So we have to be aware of that. And its earnings, which if you look on like the whisper earning going around, is Carvana's going to beat earnings by like 50% or something. They're expected to beat earnings. Wow, that's a high price to earnings ratio. Okay, so if we look at trade Carvana options, their earnings are on Wednesday. So what this means is really until Wednesday, since it's after close, like until 4 p.m., these earnings are going to be worth so much. Well, these options are going to be worth so much because earnings are still imminent. They're still coming, so there's still so much volatility to be had. But then right after earnings ends, like all of the options just are worth like nothing. So unless, like if you sold a put, like at the actual strike price and the stock tanks, then that put's worth a ton of money. But if the stock shoots up, then that put is worth nothing. You buy back for 1 cent. Okay, so here, if we look at Carvana, we sell a put over here, 284. Again, I look for 1% a week, and we're just going to go down and see where we can get 1% a week, where the bottom is. So this is the bottom where we're getting 1%. This is a little less than. And we're saying, okay, 227.5. That's not bad. That's not bad. We're going to have to say it drops to 227.5 in a week, which if we find the actual price, like how much that would have to drop out of the actual price is 284.5. 284. That's 284.5. And this means it has to drop 20%. So again, that is exactly 20%. So we're saying in a week, on earnings, this thing has to drop 20%. But it is kind of on a roll up, and it's expected to beat earnings. So there's a big chance it could just keep going up because it's been higher in the past, and the market's kind of going crazy. So we're saying, hey, I think this thing's going to go up, but I'm still going to sell a put on it and be safe by going down 20%. A lot of stocks don't drop 20% on earnings. They might drop 15%. And the thing here is if Carvana drops 15% and it drops to like 240, since we're still going to be 2 days, Thursday, Friday, we're still going to be 2 days out of this option, and it's going to have to drop another 5%. The option's worth like nothing. It's going to be worth like 10 cents. You sold it for $2.33. You're going to buy it back for like 10 cents and get $2.23. So if it doesn't drop the full 20%, you're still going to be able to buy back your option for less than you sold it for. So that's what's great. You can sell it at the end of day. Like here, earnings are after close Wednesday. You can sell the put end of day Wednesday and then buy it back Thursday morning. And if the stock goes up, that option is 1 cent. If the stock stays, that option is 1 cent. If the stock drops like 10%, that option's not worth much. It's probably 10 cents. Stock drops like 15%, it's probably like a 50-cent option. You're still making like 0.8%. And if it drops 20%, which it usually wouldn't drop 20% when it's also expected to beat earnings, then that option, still, I've had it where the stock drops my 20% and hits my target, and I still make money. I just make money because the 1% premium is just unmatched because there's not that much time left on it. And it's just crazy. Like, even if it drops to my strike price, I'm probably still making money. So that's something to notice. That's what the strategy is. You go down 20% on earnings on a company you like, and it has to be a company that's paying you 1%, going 20% down. If it goes up, you make all your money. If it stays, you make all your money. If it goes down a little bit, you make all your money. If it tanks, you probably make some money. And if it goes down more than 20%, you lose money. So you make money in almost like 90% of the circumstances, you're probably making money. Okay, so you can see why it's so appealing because you can literally get in at the end of the day and get out in the morning. So it's like you don't even have to be in the stock. You never own the stock. You just take 1% off of it. And it's really just a staircase here. Mine doesn't look so much like a staircase. Let's see. This is a staircase right here. Let me show you this. This is a staircase. This is what it looks like. All that, those are stairs. That's just every option expiring worthless. And I think this day, the option didn't do well. It dropped 15% and he was like 18% below, and he still pops up by $3,000, like by 0.7%. The stock tanked, but his option still did well. Okay, so now that you saw like all of that, we are going to actually look at go over some things quickly. Wix, right? Wix is not as good. Again, it's at a decent price, right? It's going up and it's been higher. And Wix is a good company. I've seen they've done pretty well in the past, especially with all their advertising. So here, looking for 1%, the lowest you can go is really 200, and it's at 223. That's a 10% drop. This is like 1.25%, but it is a 10% drop, which isn't very nice. I don't like 10% because it could definitely drop 10%, right? But if you really wanted to get in Wix at 200, which doesn't look to be that bad of a price, it hasn't been there all year, past year. If you wanted to get at 200, which would be like what it's at this like hop here, then go right ahead and sell that put. And if it doesn't work out, you get like 1.25%. But I wouldn't do it because it's only 10% down And if they do miss earnings, which I don't think they're expected to miss earnings, it could definitely drop 10%. Stocks drop 10% on earnings all the time. Okay, so our last stock is called HIMS, which is right here on Monday after close. So this option is going to be 2 weeks out, so it's going to be worth a little more. Oh, I probably have to show you what this graph looks like. It's kind of wild. Look at that, up 185% past 3 months. Yeah, that is crazy takeoff, but this is just an example, right? Because it's this crazy takeoff and they have earnings, the options are so good. Like, they are just amazing. Okay, so right before takeoff, for note, we're going to note that it was $25. Okay, so we're selling a put, and again, it's 2 weeks out because it's on Monday. Okay, so again, that is 11% if you were to buy it at 60, which is kind of bad. So we're going to go find out where 1% is. This is still 1%. This is almost 1%. So 37 is really where 1% stops. And again, it took takeoff at 28, but that's like a 40% drop down. We can go like 30% down, which 61 times 0.7, which is 30% drop, is 43. So if we go to 43 here, you're getting 97 cents, which is like over 2%. So again, even though the stock's so elevated, you can say, hey, I don't think this thing's going to drop 30% on earnings. And especially because there's so much hype and so much buy-in, you're like, I don't think it's going to drop 30% in the next week. Again, you could like sell this option at the end of day Monday and buy it back beginning Tuesday. And if it doesn't drop 30%, you make all, if not almost all of your money if it doesn't drop 30%. So again, great right here. Like, I might do some of this even though I hate like all the hype that goes into a lot of these stocks, right, that are up 150%, 500%, whatever. Still, sometimes you're like, this thing's got to drop 30%. I'm okay with putting some of my portfolio in that and taking 2% off of it in a day, right? 2% in a day, great. Okay, so again, that's kind of the strategy, just earnings hub, and then we go Robinhood here and just check out the stocks and see, hey, if it drops 20%, am I still going to be making money? Am I going to make 1%? And if you're not making 1%, maybe you reconsider. And if you are making 1% with a 20% drop, good. So again, if the stock goes up, you make all your money. If the stock stays, you make all your money. If it goes down a little bit, you make all your money. If it tanks, you make most of your money. And if it goes below your strike price, you either make a little bit of money or you lose money. And you'll just see how that works. Like, you'll get in a stock that's you're 20% below and it drops 18%. And you're like, oh my gosh, I'm going to lose all this money because you think the option's going to be worth so much. But since earnings are over, all that expected volatility is gone, right? So when all that volatility is gone, the options tank in value, right? And you, even though it's way closer to strike price, since there was so much volatility, the volatility was worth more than how close it was to the strike price. So you're actually going to make money or lose very little. And again, if you just keep it till the end of the week and let it expire, and if it doesn't drop below your strike price, you make all your money. Okay, well, that was my little 1% a day option that my dad and I have been doing, and it works so well. Again, try to go 20% down. I went 5% down on Ford, and I took a big loss. That was not fun. So try to go 20% down and have fun. Love you guys. Thanks.